declines in private real estate, the rally in listed real estate relative to history, and listed REIT premiums to net asset values. That's what I'm watching this month. Welcome to the Real Estate Reel from Cohen & Steers. First, I'm watching declines in private commercial real estate valuations that occurred in the fourth quarter of 2023. The NCREIF Odyssey Index, which tracks around 25 open-ended funds that own core commercial real estate, was down 5% in the fourth quarter. By comparison, listed REITs were up nearly 18% in the last 3 months of 2023. This brought full-year 2023 net total returns for private real estate, again as measured by the NCREIF Odyssey Index, to nearly negative 13%, while listed REITs were up nearly 12% last year. This may seem like a significant disconnect, but listed REITs are leading indicators for private real estate in both downturns and recoveries. Indeed, listed REITs were down 25% in 2022, while private real estate was still up almost 7% during that same period. Similarly, listed REITs were down as much as 30% from their peaks in late October of last year, while private commercial real estate is currently only down 17% from its peaks. In other words, the private commercial real estate markets are still catching up to what's in the price of listed REIT valuations. We believe private commercial real estate price returns will likely trough at around negative 25% in late 2024, but the worst is behind the listed REIT market, and there is potential for the listed REIT rally to continue. This brings me to the second point I'm watching, the current listed real estate rally relative to history. Listed REITs are more than 20% above their late October 23 trough. There have been 13 prior rallies that have risen in total returns of more than 10 percentage points, without a pullback from peaks of greater than 10%, which you can see in this chart. Those rallies have averaged almost 69% and lasted an average of 21.5 months. The shortest rally lasted only 11 months. Only one rally ended at a lower cumulative return than the 25% rally we saw to end last year. In other words, this rally is neither historically long or particularly pronounced. That said, the current rally is the second greatest 2-month rally on record. It trails only the February 2009 rally, when listed REITs rose 36% after 2 months. We don't think this is a relevant comparison today, as it was aided by Fed monetary stimulus during the Great Financial Crisis. We believe it's possible that valuations could pull back 5 to 7 percentage points from local peaks, given the magnitude of the recent rally. Such consolidation often occurs during rallies. For context, the greatest pullback from peak during a rally was almost negative 8% in December 2018. We believe investors should be buyers of listed REITs in the event of a pullback. We highlight that the sector stands almost negative 5% below their local peaks in late 2023 as of January 26, 2024. The third point I'm watching is listed REIT premiums to net asset values. Based upon Green Street data, NAVs have risen from discounts of negative 16% towards the end of October 2023 to premiums of almost 8% towards the end of January 2024. On the surface, this might suggest that listed REITs are expensive to private market valuations, but we think the premiums indicate that the market may be finally giving the sector the so-called green light to begin net acquiring assets. As you can see in this chart, listed REITs have been net sellers of assets since 2015. The shift stands to reason. Public markets force discipline on listed REITs by having them sell assets when private valuations are expensive and then buy assets when private valuations begin to cheapen. We have seen this movie before. During 2000 to 2004 and again in 2010 to 2014, listed REIT net acquired assets as premiums to NAVs afforded them an attractive cost of capital. We think this scenario can happen again, especially because listed REITs can issue debt at much more attractive levels via the senior unsecured market, whereas private peers must rely primarily on mortgage financing. If listed REITs start to acquire assets, then their earnings will grow and their valuations may not be as expensive as perceived on the surface. Subscribe to the Real Estate Reel via the link on the screen and tune in next month to see what we're watching next.